please.
Yeah, sure. So I'm Roland, coming from the market risk reporting in the JP Morgan. So because the reason why I went on PCA as my presenting topic because it's about my so today the topic is more about the rate side, which is the term structure side, because actually PCA has many applications, like in the equity side, in the volatility surveys to this kind of problem. But I will have a brief introduction about this application in the last session. But today the main focus will be on the term structure side because it's more about what I'm working. So yeah. So actually PCA originally PCA is just a mathematical or statistical tool that for the math guy. But later on the other guys want to apply this kind of knowledge into economics or finance problem like rates and volatility. So yeah, so if you go to the next one, then there are two main objectives in the PCA. The first one is to just to simplify the data structure by identifying the main factors or patterns. Because if you have a close look on the term structure of rates, say interest rate, the bond yield, or the forward, you may see that some parallel shift, the steepener, flattener, or the convexity pattern from this curve. So we want to identify if any specific patterns from it. And also the more important or the primary objective of it is to reduce the dimensionality, because if you imagine that you in your portfolio, say you are holding many bonds, you have many different tenors. Then say there are 15 tenors, or maybe you are holding some bond, IRS, etc. There are many tenors. Then you have a very giant covariance matrix or correlation matrix, whatever. Then even you just need to consider half of it because of the symmetry. There's already a big numbers here, a large numbers that you have to consider. Then it's very time consuming. By using PCA, we can simplify the process so that what we need to focus is just on the the principal component, just maybe the first few columns or the first few vectors, which you can have a brief idea of what the dynamics between these tenors are, instead of looking at so many numbers coming from covariance or correlation matrix. Is to simplify the correlation or the dynamics between the tenors you have in your portfolio. So it's what the PCA is doing. So if you want to have a clear idea or we can look at the graph that originally maybe I can. Maybe you have a clear idea of what's happening if we look at the graph. Because just for the simple case, there are two dimensions. I call it xy, okay? Then you can use PCA to transform the data, such that, for example, now the new one, xy1, xy2, and later on you will find that the new vectors are independent to each other. Then you can say that, oh, they're similar. What's the difference? The difference comes in the way that this new vector may already explain much information, in the sense that I may only consider this vector. Say you will find later on that maybe the first vector can explain most of the data, the behavior, so that we can just ignore this. In this way, we can simplify the problem by considering this direction instead of these two directions. So it's the main idea of how the PCA can reduce the complexity of the problem. You can imagine if there are many dimensions, then you can still consider maybe one or first three vectors to simplify your problem. So in the second graph, it's just talking about the assumption. The first assumption is just about the linear transformation, because you can see from the graph that if your data is not that linear or it's not that highly correlated, then this process is not that good. And also in the third graph, this one, if your data have this kind of behavior, then your PCA is not very good. But in the term structure, in the rate size, usually you won't have this problem. Usually the situation is nice. So I just give you the brief idea of what originally the PCA is. And the second one is about you have to assume that the most information is contained in the direction in which the input data variance is maximum. The meaning is that because here, how do we choose this vector? Because this vector can explain the most information or behavior of the original data or the structure, which means that if some information like for example, in your IRS or bond, there are some events just happened once, like 2008. There's a very important issue, but if the frequency is not that high because just one, okay, then you may not have this kind of information coming from your PCA because it may not explain much about this kind of behavior. So the most common behavior will be explained by the first field PC. So we have to assume that what we want to have is if the data where has a higher variance or volatility. So you have to bear in mind of this. It may lose some information that the behavior has a low volatility, and you may have a clear idea later on. And the third is just about the procedures. Just get the historical data, say the daily changes, say for example your RS or bond position, then you can calculate the covariance matrix, and then you can find the eigenvector and eigenvalue as well. So here, eigenvector and eigenvalues, what are they? Eigenvector is just this kind of vector. They are pointing to the new direction, and eigenvalue is more or less they are explanatory power, or they are in the graph you can see that actually the eigenvalue is the length of this vector. So it means that the variation captured by this vector. So you can imagine that if the vector has a shorter length, then less information is captured by this vector. So this lambda or this lambda or eigenvalue is very important. That it's telling you how much information captured by the vector, the corresponding vector. So later on you can have a look on the matrix in my Excel. So in each vector there are you will find the weighting of the tenors. Say maybe I can just show you the Excel so that you have a clear picture of what it is. And also you have your positioning portfolio. Say we can consider the DV01 in your IRS or bond position or forward, etc. Then you can incorporate this kind of information to your PCA so that you can have a clear picture of actually what your position is. Like whether your overall position is short or long. You can have another idea of what your trade is. So maybe I can go to the Excel so that you can have a clear idea of variance is maximum. Say PCAs can be applied in the image processing. That in your digital camera or when you try to analyze your image, so you can see there are many pixels in the photos that you have to consider many data. But if you use PCA, so that you can find the most important fewer numbers or fewer data, such that the outcome or the result can already be explained in a sufficient level. So in this process, what you are capturing is the most important issue. then when you have some in your image or in the graph, if there are some less important issues, then if you not use PCA to apply this problem, then you won't have this small or some small area or image in your graph. So that's why in the PCA we assume that what the PC are showing is about the variance is maximum, this issue. Sometimes we may miss something, but what we are capturing is just about the maximum variance, this issue. So yeah, and I think I can tell something about the mathematical formulation. Just have to give you a brief idea of what it is. So first one, you have some this vector X, and you can have your covariant matrix, or variant or covariant or correlation, whatever. Then here, the reason why PCA is about linearity, because we are doing linear transformation. We are doing the linear combination. We try to have linear combination of the risk factor. This one, beta is the coefficient. We are trying to have a linear combination of your eigenvectors have to be orthogonal. This is about the mathematical natures of it. So, but I won't explain it so details here. Just have an idea of it. Yeah. Then after that, you will have a linear combination of your risk factor. This one. Then you can choose, for example, the first three vectors. Say that the total eigenvalue has already been 90%. So you can you can just forget some PCs in the, say, forget the fourth one, the fifth one, the sixth one, etc. In this way, you can reduce your problem into a fewer dimensions from high dimensions. And also, if you reverse the process, the calculation of it, you can explain the risk factor with different PC vector in this way. And also you can calculate you can explain or express the variance of your risk factor with your PC. Here, lambda is the explanation power is the eigenvalue. So if you choose fewer PCs, then what you are doing is to is still have your result, but with fewer variables instead of the originally so many variables. So we are trying to reduce the problem. So geometrically, the PCs is just the main axis of the ellipsoid of this shape, and the length is the square root of the eigenvalue. So it's the basic mathematical formulation of how the PCA comes. So if we go back to the here maybe I can show the Excel first, so you can see what actually is. So here, the 10 months. Okay, 10 months. You have to input this data, then you can have the daily change here, and also these two graphs just give you the brief idea of how the curve is, the flow-term structure or the rate, the term structure. Just give you a brief idea of what they are. And also you can have your variant here.
What's the wall term structure here? Is it what's the wall term structure here?
It's just these numbers.
Okay, just the variance of each of these.
Just so you which tenor is more volatile, which tenor is less volatile. Just brief idea of how the dynamics of these numbers are. And also here will be our covariant matrix. So actually each one is just a covariant of a covariant between the tenor, and of course these cells are the variants because they are in the diagonal directly. And you will find the important features that here you will find the sum of the variant. Is this number? Yeah. And also if you I don't know what this is. Okay. And if you here find this, the sum of the eigenvalues is the same as the sum of the variance. Because actually PCA is try to redistribute the variables such that the first few or some PC vectors can already replace the whole variables. So you can expect that the total variance between them are the same. It's just kind of redistributing the variables. So you have your covariance matrix, then you can have the eigenvectors here. Here you can see that there are 11 tenors, so that so you have 11 vectors here. It's just to redistribute problem. So they have some similarities. So you can have the corresponding eigenvalue as well here. Then you can calculate the percentage of the eigenvalue. Say you have 50, 60%, 75%. Then you can run them, just run them. Maybe there are 5 PCs, but how much is your threshold? It depends on your purpose. Say I think here 95% is already enough for me. Then I can just forget other PC vector. I can just consider the first 3. Or you think, oh, this 75% is already good to you, then you can just consider this one. It's about the trade-off between the efficiency or the accuracy. So you just bear in mind this property. Then you can have a look on the. It's not 3, 5. Okay, it's 5. The 5 PC there are. But in the race, we can usually observe that this pattern parallel, or I can show it here. Here, the first 3 PCs. It's not necessarily this situation, but usually we can have this pattern to parallel the flattener or the convexity or curvature. It's most of the time we can have this pattern. So sometimes we can try to explain it, but sometimes we cannot. If say in the 4th or 5th PC here, you don't know what they are. The 4th or 5th PC, you cannot. You don't have any economical meaning for them. So sometimes you can have, sometimes you cannot. So it just depends. So if you go back to the here, here. So here, inclusion of PC, it depends on your choice. So say 90% or 80% from your total eigenvalues of the PC you have chosen. So maybe 1, maybe 3, maybe 5, it's fine. It just depends on you. So and also, if the data is highly correlated, then the power or the variance captured by the first few PC is higher, because if the data is highly correlated, then in this process, it's easier to capture by your PC. Otherwise, if the data is like that, then you can imagine that you want to capture this data with your PC vector, which they are independent to each other. Then it's more difficult to capture them. So if data is more correlated, then it's more easily captured. So that's why you have this property. The eigenvalue from your first PC will be higher if the data is more correlated. And also, sometimes we can have tried to explain them, but it's not necessary. So in the race of a three-side, we sometimes can discover this pattern. And here, the parallel shift is not exactly parallel. It's just about the same dimension shift. So if you look at the x-axis, sometimes they are not exactly horizontal. Is here they are not exactly horizontal. It's just about the same direction shift. It's different to the second PC, in which you can have positive side, negative side. But most of the time we can have this pattern. That's why we can try to explain it whether it has some special meaning. And also, sometimes we can relate this kind of situation to some real example, like rate cut or the bond buyback. you will explain the curve or the yield curve or the bond or RS will steepener, flattener. This kind of behavior may show in your PC2 or PC1. So when you use a PC, you may find this pattern and you may relate to this pattern to some monetary policies or some practical issues. But of course, again, it's not necessary case. It's just your luck to do it, to have this kind of information. Yeah. Yeah. Because you don't know the P4, P5, you cannot explain I believe. Yeah. What they are, we don't know. But for the first few, 1 or 3, usually you can have more idea of why they have this pattern. So the reason why we want to know the pattern of them, because you're trying to use it to kind of I cannot say project, but to have an idea of what your trades are. It's like here you have your DB01 from the position. Here, say bond, RS, etc., whatever, the forward, etc. You have this kind of tenor and you have your position. These are DB01. So which means that if your rates move 1 BP, then you can have you can lose 5K here, etc. So you may have your trade. Then this number is just a sum of them, which means that because this total DB01 may not reflect the true, because it has an implicit assumption that the tenors are moving in a highly correlated way. Because you're just summing them together, but you can expect in the market the rates will not move together by 1 BP at the same time. It's not realistic. So if you consider this number, which is the total of them, it's just a little bit unrealistic. So we want to have some more realistic number of about whether you are long or short. Then you can use PCA to incorporate the historical data, so that the numbers coming from PCA is incorporate more about the market movement, instead of assuming all tenants are moving 1 BP, so whether I will lose or earn money. That's why we are doing PCA here. And if we go back to the then here is about we try to explain your portfolio by using PCA. And if you want to know how why is it, we can go to here. Yeah. For example, you have portfolio Z and your is a weighting is just like here. Is maybe your DB01, W is your DB01, and R is just the interest rate change. Then you can see you want to know the sensitivity to your portfolio, so that you can see whether it's risk or not, whether long or short, etc. Then, for example, we consider only the for simplicity, there are 3 tenors and 2 PCs only. Then your portfolio will have this kind of expression. And because, as I mentioned before, here you can explain your tenor in terms of your PC. That's why here, 2 PC, you can explain your tenor in 2 PC, in the linear combination of 2 PCs in this case. Then you can just plug in and you will find, just rearrange them, then you can explain your portfolio in terms of PC. And the sensitivity of the correlation is just about the sum product of your DV01 and your weighting coming from your PC. And also you can calculate the variance of P&L. Then you can have this kind of pattern. It's just about the square of your coefficient and the lambda, because eigenvalue is the variance of the so-called variance, okay, or the exponential power from your PC vector. So here you will see lambda here. And that such way matter because the PCA are correlated, so that's why the problem can be solved easily. You don't have to consider covariant terms here, they are correlated. So that's why here you will have this kind of equation. The way I do it is just to some product to each tenor to your position here, to give you an idea of
what's in O? What's in O column?
It should be here. It's the rating IPC, and it's your position. So here is the numbers coming from them. some product of them. So here I just choose the first 3 PC because it's already 95%. I think it's good enough. So I just forget other PC to simplify the problem. And also you can have the rating from the all 3 PCs, and then you can have this summing again. You can see here 27. Here it's just you are long 8K duration or DV01. They are different. Sometimes they're more or less the same. Sometimes they are different. Why? Because as I mentioned before, if you just sum them together here, you just implicitly assume that the rates are highly correlated, perfectly correlated, that they move 1 pp at the same time. But in market, it's not this case. But if the market has a period in which the rate is quite highly correlated, but not perfectly okay, but quite this pattern, then you can, in your PCA result, you will see that they are more or less the same, because PC1 usually, or the PC with the highest exponential power, usually is about to shift. So if the market you investigate has really this property in this period, then you can find they are the same. But if they are different, it's very useful, because the market is very volatile maybe sometimes. So what's doing here is try to give you whether your portfolio overall is long or short, while you incorporate the market behavior in the past instead of your unrealistic assumption. So actually here you this 27, but in reality you are not losing that much if the rate moves up. So you will lose less. And also here is other PC, and also the power. And you can try to weight your total DV01 by your eigenvalue, because eigenvalue is just about the importance of the factor, but it's not a formal practice. It just gives you some idea of, if I just weigh them and I will see 7K if the rate move up 1 BP, then again it is incorporated the market information instead of this linguistic one. And also you will find that maybe we can go back to the slide here. Keep going. Okay. Yeah. And here, it's just about whether they only when they are parallel shift highly correlated. Then, yeah. And otherwise, there are some specific events like the race cut or the bond buyback, so that you will observe the patterns quite steepener or flattener. Then this kind of behavior will result in the difference between your summing up to DV01 to your the first coefficient coming from your first PC. And also you can try to normalize them based on most liquid tenor, but also it may not be a formal or formal pattern. It just gives you some idea of what they are. Like here, you can try to say, if you think say 10 years is the most liquid tenor, for example, or 1 year is the most liquid tenor here, then you can just normalize them by dividing all numbers by the not number, but here. Normalize your eigenvector, the weighting of your eigenvector. Say 1 year, if one year is your most liquid tenor, then you can divide all the numbers by this number, so that you can see if this most liquid tenor have a 1 BP move, then what's the behavior, or what are the behaviors of other tenors. You can see the dynamics between them, because here the first PC, the first PC or the first few PCs is talking about the dynamics between them. Again, it's just about the covariance matrix, but you can see there are so many numbers here. If you only consider the first PC, actually the numbers you have to consider are much fewer. So again, it's try to reduce the dimensions and just see the numbers. You can have an idea of how the rays are moving together. So yeah, so here. that's why you can have an idea of their relative performance by normalizing them using your most liquid tenor or other tenor you like. So, but here the explanation is just more qualitative than the quantitative, because again, actually PCA overall PCA is more qualitative because because it's talking about the historical information. It has no any information about the future. Of course, you can expect the future may have a similar pattern to past, but it's your own view only. In this PCA, it's nothing about the future. So it just gives you a brief idea of how the movement or dynamics of the race in the past period in a more convenient way. Yeah. And also here the variant, you can calculate the variance as I mentioned before in the last slide, the mathematical stuff. Then its eigenvalue is rho square. So here, why we are doing this? Because sometimes we want to use the first PCA only. Maybe the first PCA has already 80 or 90% power. That you may think, oh, PC1 is already enough. But sometimes you have some case to consider, because maybe your portfolio has some very large position sensitive to tenor that appear unimportant in PCA result. Say here. Here you have some maybe very large position here. Then you will see, oh, here if you only consider first PC, then if you think 75% is enough, whether 17%, 80%, 30% is enough depends on your own judgment, your experience in the market. But anyway, you think it's okay, then you can trust the number. But in PC2, there's 5K the DV01, so if there's 16%, and also here, so actually here is formula, and you can find this number are quite different from this number, because from this number you can conclude that PC1 is good enough, maybe because 75%. But here, if you incorporate your risk position, your portfolio numbers, you think that, oh, how come the PC1 is so low and PC2 is nothing? Why? Because the positions here affect the exponential power of your portfolio as well. So in here you think, why PC3 has a high percentage? Because you can expect here 1 year the numbers, and 1 year here. You have a very large position in your 1 year. That say, because in the first PC it's only 10K, and here you have 15K. Because in the first PC you can have a look at the graph. 1 year is not that huge number, but in the third PC here it's relatively larger. So maybe the likelihood of PC3 is not that high, but if this happens, then you will lose a huge number. If the number is higher, then it will be higher. So if you only consider the PC1 because of its high explanatory power, but you forget this point, then if the PC3 the curvature of convexity, this kind of pattern happens, then you may lose a lot, although the likelihood may not be that large. So that's why here you should not consider only the exponential power, but also the P&L variant or the power from your P&L, so that you can see whether if there's something strange. But I think you don't need to do this kind of analysis every time, because it's quite time consuming. What you can do is try to focus on whether there are very large positions in your portfolio. Say if you think, oh, therefore 40K is quite large, then you can have a look on whether it's good or bad. But otherwise, you can just forget this area. If the position is quite flat, then you can just forget it, because the situation here will not appear. Yeah. So, but here just explain why we have a look on this issue. Just aware of it. If you only use your first 1 or 2 PCs. And also here, sometimes you may think about correlation of covariance matrix, but what's the difference? If you use the covariance matrix, it's more about the individual dynamics, and correlation is more about the co-movement. It's more about the co-movement. Because correlation remove their scale, and covariance remain the scale of from your variance. So there are difference here, and also here. But here when you use the covariance matrix, you have to consider whether you have a similar scale or unit of the variance. Because if you use the correlation matrix, the good thing is that the dimensionless. It's good for data with different units. Say for example, if you wanna have your bond yield using the PCA with the I don't know, maybe for your research purpose, you want to include the inflation rate, the treasury rate, the GDP, whatever, I don't know. Then they have different units. Then in this case, you cannot use covariance matrix because they have different scale, different unit. That it doesn't make any sense to use covariance matrix. If you use the correlation matrix, it's a kind of dimensionless. That's why you can incorporate the data with different scale or unit and I think it makes more sense. And also the properties I mentioned before is the sum of the eigenvalue, and the sum of the eigenvalue is the sum of the variance. It's kind of with dispersion of your variance. And if you use the correlation matrix, the sum of eigenvalue will be the numbers of the risk factor. Like here, here is a correlation matrix, then you will see that here 11, because there are 11 tenor. Then you will find that the sum of the eigenvalue is 11. It just gives you an idea of redistributing the variables. And also you can expect the correlation tends to higher among the long n because of less volatile when you use you can observe this pattern. But of course it's not necessarily true, it's just at the most case. Then that's why but here if you for example like to incorporate the fixed income or the rate or the bond IRS, then I think most of the time you can use the covariance matrix. But if you realize that the scale are quite different, then you have to think about it before using it. And that's how the data chosen. The tenor, usually it's better to use the high liquid tenor because it reflects more market behavior. And also the look back period, it depends on the project period. Say if I want to project the coming 3 months, then you can just look back 3 months. But again, a project has an implicit assumption that the futures doesn't change much from the past. And if you observe the constant pattern using different look back period, then it just implies the stability of your dynamics of movement. And the frequency depends on your project period again. Say if you are doing the 1 year, a few years, or just a few months, then you can choose whether you use the daily data, weekly, or monthly. If you are 10 years, so it depends on your purpose as well. And then the benchmark is the normalization. If I mentioned before, if you want to have some relative movement idea, then you can just use the most liquid one to give you the idea.
Okay, two questions.
Yeah.
One is regarding the sheet.
Sorry.
There was a column mentioning
Your PC vector.
That over, let's say on the 1 year CMS.
Yeah.
So then if you normalize, then you'll have a result where rather than saying I've give you a 1 and the whole curve moved by 1 BP, that's my PNL impact, you'll say if the 1 year moved by 1 BP, the rest of the curve will move, and hence what is going to be my PNL impact, right?
Yeah.
That's what you're getting
Yeah.
at the end. You didn't do that, right?
I didn't do that, okay. But you can do it. Why we may want to do it, because let's say there's a bond buyback in 10 years, the government.
Right. Okay. So you think this one is going to move the?
So you can expect that the 10 year will be the driver.
Yeah.
Then you want to have look when the 10 year have a 1 BP move. Then how's the other?
Exactly, and then rather than doing that simplistically with the DVO1,
Yeah.
and you know this is not realistic, you'll get a much better picture by normalizing on that 1 year point, and then looking at the result that you get over there. Yeah. On a weighted basis, you look at row 18 to potentially.
Yeah. So again, it depends on your purpose, whether you want to look the overall long shot or want to have a look on the relative movement. So this one,
good indicator actually.
Yeah. So this one is one of the nice property of the PC because it's quite flexible. You can incorporate your own view, but I will just talk about it later.
One more thing. So you have your P&L realized daily, right?
Sorry?
So I'm just asking. There's a question about the predictive power of this PCA. So here
it can also give you the idea of the dynamic between this product or currency, if you like. And so here, if you want the non-deliverable forward IRS and bond of same emerging market currency, then in the developing country or in emerging market, you may expect the NDF is more volatile, except some developed countries or places. Then in this case, you find that the NDF is more volatile than IRS and bond. So if you are encounter this situation, when you try to combine the PCA here, instead of doing the separate PCA, you may find that the NDF pattern is quite similar to the previous one. So like here, if you want to do actually this kind of PCA is just about say NDF you have 7 tenor, IRS has 7 tenor, and also bond has 7 tenor. Then the dimension of your correlation matrix may be 21. Then you of course you will have 21 PC vector. And if you like to only take the first PC will have 21 rating for tenors for NDF, IRS, and bond. Then you can just break it down to the first 7 tenor maybe for NDF, the 7 tenor from IRS, 7 tenor from the bond. You can break them down from your first PC of your combined or the PCA here. Then you compare the rating coming from here to the rating coming from your separate or individual PCA. You can compare the pattern, whether the pattern preserved here. Then usually the NDF in this case will preserve more because there has NDF is more volatile. Its higher variant can be easily explained by your first PC. On the other hand, the IRS and bond will not preserve the pattern much if you compare the graph coming from the individual PCA and combined PCA and the combined PCA. Then if you do this kind of analysis, you have to think about whether it will give you some meaningful result. If you don't know this, you just know why the IRS and bond have such a different pattern. But if you know about it, you can try to exclude this kind of high volatility stuff from your consolidated PCA, so that or it's already given you the insight already, but it's just a phenomenon that you can explain why. So if you remove NDF from your analysis, you can expect the pattern will be better. The IRS and bond will be better because of the different dynamics and the high volatility. And the drawbacks, the first data in which the data have some equivariant, because what PCA is doing in the mathematical side is try to choose the vector, choose direction in which the direction can explain the corresponding variant or the explanatory power. So if there are two directions with equal variance, then mathematically we don't know which one we should choose. So that's why in this mathematical tool, it fails when there are some data with equal variance or equal volatility. If you encounter this situation, you can just remove one of them first, and the final stage you can just interpolate interpolate back to your tenors, because it will fail. It's the PCA drawback. And also, it failed to capture the risk, like do not contribute much. Like we do the in the previous example, bond and swap compared to NDF will not contribute much to the total covariance or total variance or total variability of your data. That's why you have to aware of it when the data involved has some particular high fall. Yeah. And also the liquidity or idiosyncratic risk will also affect your PCA because it's just kind of one-off event maybe or specific event that is like in the when you want to have a credit trading, say the bond and CDS, compared to the FX trading, like the forward, the future forward, and the IRS. Then if your CDS or bond, especially bond, is not that liquid, then you can expect your PC will not have a very high power. Then or the result may not have much significance because the market behavior is quite different from your specific event or some credit issue for CDS or bond. So the results coming from PCA for the credit trading may not mean quite a lot compared to FX market, I think. Yeah. And also the choice of historical data is also the important thing we just discussed it before. When you use the PCA, you just explicitly assume that the future will be the same or more or less the same, or you are focusing on the general market behavior instead of the perfectly projecting the future. So again, it depends on purpose. Yeah, one buyback and raise. If you say the past 3 months there are this issue, but if you don't think they will happen in the coming 3 months, then your PCA may not be so meaningful. You have to, or when you use a PC, you have to think about this issue. Whether there were some special issue in the past, and will then happen in the future, you should think about it. And also there are some further applications that you can have a brief idea of what else the PCA can do, but I won't have much detail on them because I just know you can do it, but I don't have spent much time on them, just know about it. The first one is about the regression, because PCA has a very nice property that the PC vectors is independent to each other. It's quite important in regression. That's why you can use the feature for your regression. Another second thing is about the butterflies.